Hello listeners, welcome to this episode of Cryptonomics. Before we jump into today's discussion, please keep in mind this recording is for general education and is not intended to constitute investment advice. Any opinions expressed are those of the participants and do not necessarily represent those of Witham. Hello everyone, and welcome back to another episode of Cryptonomics brought to you by Witham. I am your host, Mark Eckerly, and today I welcome to the show Eric Weiner and Will Brannon, both of whom are partners at Lowenstein Sandler and lead the firm's digital asset practice. Today's episode will be breaking down the SEC's lawsuit against Ripple and the order that was issued last month. But first, I want to kick it over to both of you guys. Eric, why don't you start? Give us a little background on yourself, Lowenstein's crypto practice, and a few of the exciting things that you guys are working on.
Sure. Thanks so much, Mark. I appreciate the opportunity to join you today. As you said, my name is Eric Weiner. I'm co-chair of Lowenstein Crypto. I'm also a partner in our tech group, which is our emerging company venture capital practice. Our crypto practice is very broad. My role in it is essentially representing startup companies who have some sort of a relationship to the blockchain or NFTs or tokenomics, and representing venture capital funds that invest in those businesses. I'll allow Will to speak about what he does, but we, in addition to what Will and I do, our crypto practice also includes helping out companies with NFTs and commercial contracts and contracts relating to the chain and regulatory issues. So we like to try to touch the sort of the crypto world on all angles.
Yeah, and so for me, I'm partner at Lowenstein Sandler. So I work with Eric in the Lowenstein Crypto Group, and also I sit within our fintech practice. And so there's a lot of overlap just in terms of clients, products, right? The types of things that we're working on sort of across both of those, right? From the fintech perspective as well as, specifically crypto. But most of our clients are venture-backed financial technology companies, right? Pre-seed all the way through to growth. And so typically in our group in the fintech side, right, helping them figure out from a regulatory perspective, right, that may include digital asset securities considerations, trading platforms. We represent a lot of sort of OTC trading desks as well, right? Kind of trying to fit them from a regulatory perspective into the right bucket, which, can be somewhat challenging on the crypto side. And again, a lot of those clients sort of sit, right, different parts of the firm are touching those clients, right? Eric may be, right, working with them. From his perspective, we have the commercial contracts side of everything. And also, for the projects that end up sort of in the crosshairs from a regulatory perspective, we have a robust litigation group as well that has walked a lot of clients through investigations, enforcement actions, stuff like that.
In a nutshell, it's an interesting time to be involved.
Yeah, the space isn't slowing down or waiting for regulation at all. And I mean, we see it on the accounting, advisory, and tax side, and I can only imagine how much you guys are seeing it from the regulatory front, because clients are building all types of products, all types of token issuers. It's everyone that's popping up nowadays is unique in and of itself in some way or some shape. So it's definitely interesting and keeps us all on our toes, that's for sure.
It does, and it's funny, and clients talk to each other, and we get questions. Well, I spoke to this fund or that fund. They no longer want to do a token warrant in light of Ripple or this, that, or the other thing. And, it's interesting it's a very interesting practice to be a part of, both frustrating and interesting because the regulatory landscape is so unclear. And even in light of Ripple, it's, there's some clarity there, but there's really not all that much clarity there.
That's a perfect segue into the Ripple case. So I want to, before we dive into where we are today, I want to jump back to the beginning of the original lawsuit the SEC filed against Ripple, when it happened, why it happened, kind of what was their original motive. So Eric or Will, I'm not sure who wants to take the lead on this, but take us back to the beginning, just the original concept of the lawsuit and why it occurred.
Well, I think we're all familiar with Mr. Gensler in the SEC, right? And seems somewhat on a crusade to make clear that any of these types of tokens are securities that need to be regulated by his organization. And look, Ripple was sold in many different ways as outlined in the case, or in the recent judgment. A lot of money had changed hands, and the SEC wasn't involved in regulating it. And I think that's where it started. I mean, that much money. We're in the world now where there's been a lot of famous sort of explosions of fraud and the like. And I think the SEC wants to make sure that their hands are on it. And I think they have a very strong view that these tokens are securities in most cases. I believe they've said it on, only Bitcoin should be excluded, although I think that's not true. But that's how it started, right? A lot of money changed hands both into Ripple itself and into the founders of Ripple.
It's funny you say that because there's actually, I think, a video that surfaced of Gary Gensler in like 2019 stating a couple different digital assets that are not securities, but now it's who knows what's what today, right? The SEC could have a different purview tomorrow. Okay, so fast forward to July 2023. Right? This lawsuit's been going on for almost 3 years now, 4 years. A few short weeks ago, what did Judge Torres issue as part of her order? Let's break down the ruling, the outcome, and what are the key takeaways? Kind of what led us to where we are today.
I mean, I'm happy to start. I'll start with what I think this decision is making clear with respect to what is a security. And then I'll let Will talk about the programmatic sales piece of it. I'm sure some of your listeners are aware of the Howey case, which establishes a test for, what's a security, whether we're talking about tokens or orange groves or any sort of investment contract. And I think in this case, the Judge Torres sort of made clear that, look, very similar to cases that have preceded the Ripple case, if you have something that is being sold for money in a common enterprise and the individuals or entities that are acquiring that something are expecting to profit off of the work of third parties that are selling it, it's security. And it doesn't really matter what the underlying thing is. So, I think they use examples in other cases. If the underlying thing is a pig in and of itself is not a security. But if there's a scheme or some investment contract that sells the pig, it very well could be a security if the other prongs of the Howey test are met, which is a common enterprise. Pursuant to which, there's an expectation of profit by virtue of the work of those that are selling them. And I think that's where we are. I think that's where we are after Ripple. And I think a lot of Ripple, at least in this institutional sales prong, where they sold XRP to these institutional purchasers, I think that just reinforces that in those situations, we have a security. What I was going to say was one thing that I think is really important about this particular prong of this decision is when Ripple and its founders were talking about XRP, they were disseminating information about it over a wide scope. They were talking about it. They were talking about it on social media. They were on YouTube. They were giving out reports and all this stuff. And it wasn't just to some limited group of people. They were promoting this to the world. And then they sold the actual XRP pursuant to these investment contracts. So I think taking all those things together, it was sort of a totality of the circumstances test. You look at all those things under Howey, and if you're going to sell anything, token or otherwise, in this way, it's going to be a security.
So from my perspective, looking at it, it's there's obviously a lot of back and forth, right? You have the history of the case, right? It's 3 years. There's been a bunch of different motions, right? We had various documents released on the SEC side, right, about a month before the decision or the decision came down. To me, the takeaway is kind of, I think, what a lot of people in the industry have been saying, right? XRP itself, right, is not a security, right? It's all about the wrapper, right, and the context. Like similar to Eric's point, right? You may have an orange or some sort of item. Like that item in and of itself is not a security. Like that sort of directly contradicts, right, the position that the SEC, I think, has been, either overtly or sort of implicitly suggesting over the last couple of years, particularly since, right, Gensler has sort of led the charge, right? And so then it all becomes, right, you're sort of in what I view as a more traditional framework, right? You're looking at a token or an asset. You now have to think about, does this look, right, is this being offered in a way that kind of looks like a capital raise, right? Where you're reaching out to people, they're giving you money, right? And obviously the clear hope is that you're using that money to build out your business, build out the network, right? And people are sort of expecting a return. But when you kind of compare that to like what's identified in the decision as sort of programmatic sales, those sales are really sort of from a number of transactions perspective, right? The huge majority, right? And that's what I think most people care about, right? You have all these tokens listed on exchanges. The court said, look, when it's this sort of blind bid-ask structure where I'm going on to an exchange, XRP is available to buy, I buy it, I don't know who I'm buying it from, I don't have this relationship with, right, the in quotes, issuer or the creator of that token, right? I'm not, I may be buying it because I hope it goes up in value, but that's not, right? It looks very different than like the institutional example that they give, right, in the decision that Eric was talking about, right? Because that kind of looks and feels like a traditional capital raise, right, in some instances, right? Whereas the programmatic sales, buying and selling, blind bid-ask fashion is very different. And so to me, that sort of getting some clarity, at least as to like structure and approach, right? The underlying asset's not a security, but now we have to look at like the surrounding facts and features, right? The totality of the circumstances, right? Which is typically the test.
Which is interesting because if you think about in a footnote in the decision, when they were talking about the programmatic sales, they had mentioned secondary sales. And one thing that remains open now is under this decision is a secondary sale, one that is going to be governed by Section 5 of the Securities Act. And it's maybe, and the court in this case didn't answer the question. What they did say is it's maybe, but it'll probably be another totality of the circumstances test under Howey to make a determination of whether or not a secondary sale is going to be governed by those specific securities laws. But that gives some gray. I can imagine seeing some secondary sales being consummated in light of Ripple that are not going to be registered.
Do you foresee that Section 5 piece, some of that gray area, being any part of the appeal process from the SEC as part of this ruling? Could they bring that up as kind of some foundation to build upon, or no?
Oh, I think they're going to appeal.
I think they're going to appeal.
As for what they're going to argue, I just don't know. I mean, I think there was like hundreds of facts in dispute in connection with the summary judgment motions. So I'm certain that they're going to try to pick this apart. Hard to know. I don't know if Will has a different view. It's hard for me to know where they're going to stand. But I think the decision made it was very well written with respect to the programmatic piece. Seems a little, in all cases, but the programmatic argument, one where it's a blind bid ask and you don't know who's profiting from it or not, seems to be a clear and a reasonably clear to me exception to the Howey test.
Yeah. I mean, I think my sense is they're going to write every single fact in detail, right? It's going to be something they're going to push on. You do get to this point where it becomes, just from a practical perspective, kind of hard in some ways, right? Because if you take a step back, most of the recent activity from the SEC has been, right, focusing on intermediaries, right? And right, so you have Coinbase, probably the most, prominent example, right, where being charged with, right, effectively acting as an unregistered broker-dealer because some number of the tokens are unregistered securities. But you're in this sort of bizarre situation where the actual issuers haven't been charged, right? Ripple is a little bit different, right? It's, again, sort of precedes some of the more recent activity. But I think it becomes hard, right? Because once you start focusing on secondary transactions, like the consequences of an unregistered security sale and trying to follow the chain, right? For like rescission rights and all that kind of stuff, especially in a crypto context, right? How do you even like begin to, the billions of transactions? Yeah. So it just becomes a bit, I think they're going to pick and choose, but I think it's going to be broad scale in terms of like fighting and
Now, many, I would say, in the community observers, if you will, view this as a victory. Do you guys see that this ruling is a victory for the digital asset community and for other companies? Or is it is there a potential takeaway from the SEC here that they have some foundation to stand on and something to build upon, that formal guidance came out? What is your takeaway, positive or negative, from this ruling?
I mean, it's funny. I think in the first 48 hours after this decision came down, it was almost like a ticker tape parade in downtown Manhattan. And I think that that's tempered. I think there's just still a lot of uncertainty about that initial step. How are we really going to structure these things? because not every sale is a programmatic sale or a distribution to an employee or something like that. The SEC is going to fight this, like Will said, tooth and nail. I think we need to take a wait and see approach. Certainly, I think this is a positive for the crypto community, and I think a small step, but a step in the right direction of getting some clarity. But unfortunately, there's no finality here. The appeals are going to go to the Second Circuit, and we're going to see what ultimately happens. But I think to Will's point, seeing a judge make clear that, like, just because you're XRP doesn't mean you're a security. I mean, here there was a very clear statement to that effect. There has to be more than that. So that's a good thing. I think good in the right direction, but it's not over. And I would be, cautious to start structuring tons of different wrappers around tokens based on this decision alone. So I think it's, we're seeing activity. I'm seeing the same type of activity in the venture market with respect to, crypto-based startups that I was right before it. And interestingly, seeing some fear with respect to some of the tokenomics that we've been commonly using in the marketplace for venture rounds. So, if a fund is buying equity of a company and then potentially getting rights to a token, there's a bunch of flavors of that. One of them being a token warrant. Some people are now afraid to get a token warrant, even though in our case, it's a very limited offering to highly sophisticated and accredited investors. It's not something that's being broadcast over YouTube to 5 million people. So the initial issuance is probably fine. But actually seeing some fear, which has surprised me in light of the decision.
Yeah, I was going to say, just to chime in, I think definitely 100% positive. I think a cautious approach makes sense. At the same time, I wouldn't be surprised. I think if you see certain, more aggressive market players, right, kind of using this as a blueprint, right? Because in some ways, right, if your end goal is programmatic sales, right, you somewhat have, right, fitting within the confines of sort of what the facts at least as presented in the order. Obviously, it's subject to appeal, but I think, there's a risk spectrum there, and, we definitely see people all across that spectrum. So I wouldn't be surprised if you see some people trying to kind of create a framework, right, effectively just sort of transposing the facts here, right, and taking the route that they see as there's at least some light at the end of the tunnel, as opposed to prior, right, before the order. Everything from the SEC was, it's all security. You have to come in and register. Of course, when you go in and register, you're not going to get approved, right? So you're sort of stuck in this dead zone. So I think some people will sort of jump at that limited opportunity.
On a little bit of a separate note, kind of, Eric, to the point you were making, are you guys seeing outside of 2017 to 2019, since then, since this Ripple lawsuit kind of went into effect in 2020, have you seen a slowdown on token issuers and the ICO process as a whole? I know it's been changed and everyone puts their own, like you said, type of wrapper on it, what the look and feel is. But have you seen a little bit of a slowdown there, or are people still chugging full steam ahead with different makeup of what that looks like?
I can tell you what I'm seeing, and I'd be curious to hear Will's thoughts on it. About 18 months ago or 20 months ago, when crypto companies were sort of coming out of the woodwork like wildfire, we were seeing more companies than we even knew what to do with. There were just tons of companies. And you were seeing these very outsized equity valuations on those companies because the thesis from the investors was, I want to get a pro rata right or some access to the ultimate token that they're going to issue. I care about the equity, but I care about it a lot less than the token. So we were seeing hyper upsized valuations, companies that are 4 months old, 6 months old, 8 months old with 9-figure valuations on the equity side. Now that has really changed. We are not seeing that, at least in my practice, I am not seeing that. Equity valuations are much, much, much lower, even when there are tokenomics related to the deal. And what I'm hearing in the marketplace from clients that I deal with, though some of disagree with me, and that's very healthy and fine, is that there's the belief in the technology and the blockchain and what it will ultimately become is there. and that there's really incredibly bright and dynamic people in the space who are going to do great things with it. But people are actually believing in the equity value now and maybe investing more about the equity value in these companies than necessarily the token. They're protecting themselves by getting some right to the token in the future if it's ever minted, but it's okay if it's not in a lot of these situations. That's my experience right now.
So from the fintech group perspective, a lot of this tends to sort of come in waves, like to Eric's point. You go back and look at the calendar, 2019, 2020, a lot of token projects, right? You have 2021, right? There was a lot of NFT type projects, which have now really at least gone down from the sort of the hysteria, right? That there was at a point in time. I think a lot of the things we're seeing now is sort of more of like a surgical approach, right? Especially on the financial services side, right? Trying to figure out what is actually sort of solving a problem where a token makes sense, right? And where there's at least some amount of clarity, enough to kind of get up off the ground and sort of experiment from a project perspective. Right, we're seeing a lot of interest in like projects dealing with sort of like tokenized treasuries, right, and sort of other sort of real world assets. Those have sort of always existed, but I think as funding has sort of become harder to come by, right, the cream in some ways is sort of rising to the top, and I think we're seeing a lot of really interesting teams, with good experience, right, both from the tech side as well as like traditional financial services, which I think at this point you sort of need, right, given just the significant regulatory scrutiny.
My last question, that's a great segue into it, where seeing what kind of regulatory clarity is potentially on the horizon, right? I mean, I personally on the accounting side, right, we're going off FAQs from the IRS. We're going off like notices or addendums, or it's very few and far between of actually clear-cut guidance that we can fall back on. And I feel like it's very similar on the regulatory side where you're using these rulings as a mandate, or you're using certain verdicts. And I'm just curious to get your thoughts when we should expect, can expect, if ever, some type of clarity from the regulatory front. Because I know a lot of companies I work with that they want that direction. They want to know what the path forward is. They want to be following all the right laws and compliance, but they're just trying to figure out what that is as it relates to digital assets, right? It's trying to fit that circle in a square peg and see how digital assets fits into the traditional finance world. So I'm just curious, both of your point of views on that.
And you just had your the ruling on crypto staking, taxation of crypto staking rewards, right? I think this is a really hard question to answer, and I wish I had that crystal ball. The one thing I do genuinely think, though, is I think the Ripple case puts a little more pressure on the SEC. I mean, this is a punch in the gut on some levels to them. And hopefully that means there will be some increased desire to stop regulating the way that they're doing it now. What that means, how much it accelerates, I don't know. But this is certainly a positive in that regard. I think there will be more clarity sooner than later as a result of it.
Yeah, I'm not hugely optimistic for broad scale clarity. I feel like people have been sort of asking this question for quite a while now, and it's right. There'll be something that'll happen. There'll be a bill in Congress that people are sort of hopeful that people will sort of coalesce around. But I think part of the problem from a U.S. perspective is just the regulatory structure, right? Unlike most other countries, you have multiple regulatory agencies. You have the SEC, you have the CFTC, you have states, you have money transmitters, right? All sort of competing, giving guidance that oftentimes conflicts, which just muddies the waters in such a way that I think a lot of other jurisdictions don't face that type of problem, right? They have one financial regulator. Everyone's on the same side. They can sort of take meaningful steps, sort of test the waters and sort of roll things out. Whereas in the U.S., you don't have that to the same extent. And I think there have been some movements, right, on the SEC sort of FINRA side. There's been some rulings about, broker dealers that can custody, right, digital asset securities. It's limited guidance, but nothing's really happened with that, right? That was a couple years ago. We just heard recently, even large institutions like Robinhood, right, applied, got rejected. And so if that's any indication, I think it's going to be potentially slow going. Again, I think there's this constant sort of paralysis about the fear of the unknown. We submit a rule, we create some sort of structure, and then before you know it, right, there's an FTX-like event, right? And now instead of that happening in a vacuum, it's happened under this framework, right, that a regulator has put forth, right? And then they're sort of in the crosshairs. I'm hopeful, but I think it's going to be a tough slog to where we get to a place where it's no different than saying you want to start a typical traditional securities broker dealer where you just go through the process. Everyone knows what it is. I think it could be some time before we kind of get to that place.
And that's what I've been saying for a while. I feel like last 4 or 5 years, 4 or 5 years ago, it was the regulatory agencies are taking their time. They want to make sure they get it right. And nothing's really changed since then, at least too much. So I feel like we're still in like a holding pattern. So I'm definitely not holding my breath by no means.
And unfortunately, it's not like we have a Congress that moves quickly either. And there's still antagonism from the SEC for sure. Let's see if this decision, Coinbase is ongoing, stuff is going to move something in the right direction, but moving in the right direction could be molasses either way.
That wraps up today's episode. I really appreciate you guys taking the time today, Eric and Will. Thank you both for joining me. If you want to learn more, visit Lowenstein.com. They have a crypto practice and a landing page there, so you can see more insights, sign up for their newsletters. And yeah, thank you guys for joining me today.
Really appreciate it, Mark.
Yep, thank you.
Thank you. All views expressed in this podcast by Mark Eckerly or his guests are solely their opinions and do not reflect the opinion of Witham. This podcast is for informational purposes only.